Something I recently read was very interesting. Reportedly, the effects of coronavirus shutdown are being felt everywhere, even in the Earth's crust. Apparently, the decrease in activity and transportation have led to a noticeable drop in seismic noise. Nature reports that this could help seismologists detect smaller earthquakes and more closely monitor volcanic activity. Moving vehicles and industrial machinery usually cause vibrations that can get in the way of research. It's a bit more quiet where I live too. Now, if we can only get the politicians and the celebrities to shut up, it could be more pleasant. Somehow, I think that may be a bit too much to ask for. As for the stock market, are we in for a quiet period or are things going to become chaotic again? Well, let's take a look. For the new subscribers, we have recently talked about being cautious in the market. If someone wants to invest, I have suggested that a cautious investment would be to place 25% of your investments each month over the next 3 to 4 months. Some caution is advised because the stock market still needs time to repair the recent technical damage. The coronavirus numbers will likely continue higher, but that doesn't mean the stock market has to go lower. The stock market typically discounts what will happen, say, 6 to 9 months from now. And of course, the big question on everyone's mind is, has the stock market priced in the economic slowdown? The recent volatility tells me that the market is still working on that answer. Regardless, there are some reasons to remain positive. In order to judge the health of the market, look at the price action of leading stocks. While many growth stocks still need time to build proper technical bases, some encouragement is shown by some of the leading growth sectors such as software, biotech, semiconductors, and medical products. Over the past week or so, many stocks from these sectors are recovering well and are searching for new highs. Be patient, but the recent price action is constructive. Whether you've been in the market very long or not, most people reflect back to 2008 to 2009 and the great financial crisis when another crash occurs. This is only natural since the crisis caused a lot of mental damage and is still fresh in people's minds. So many investors are feeling like we're headed for a 50% decline. But remember that the average bear market sees a drop of only about 27%. Well, I say only 27%, but we've overshot that. However, to me, this market is more similar to the crash of 1987 and the flash crash of 2010. So let's focus on these two crashes to gain some insight. The main point of both charts is that after the initial low was made, the market didn't go significantly lower on subsequent downdrafts. Looking at this chart of 1987, the initial crash was followed by a successful test of the lows that came about a month and a half later. The market stayed in that general range for about 4 to 6 months before eventually moving higher. And this chart here shows the flash crash of 2010. And this chart's a bit different from the chart from 1987 in that the stock market did go down further after the initial crash. And in fact, it went further on two occasions. But the two tests of the lows also occurred within about 4 months of the initial downdraft. That's why I'm stressing patience in order to give the market some time to heal its current technical damage. And that's also why I suggest investing in stages over the next few months. If you do that, you have a better chance of catching the lows, and your average will be much lower than if you just went ahead and invested everything at once. So, the next question, when will we test the recent lows in the market? Well, tune in for the market update on Saturday, and we'll talk about that in more detail. And so for today, that's ChewDog Charts. Thank you.